Hey everyone, good afternoon. I'm Lance Davis, Editorial Director for Bankrate. Thanks so much for joining us for our Finish Strong webinar. 2021 is almost here and things only seem to move faster as we near the holidays. So today we're going to discuss the latest on stimulus and forbearance. There's some important dates to be aware of here. Mortgage rate movements, some budgeting and credit card strategies for the holiday season, a bunch of different tips. And we're going to be answering your questions throughout. Today, we're going to be joined by Greg McBride. Greg is a chartered financial analyst and Bankrate's chief financial analyst. For those who have joined us on previous webinars, you're very familiar with Greg. For those who haven't, he has nearly a quarter century of experience as a personal finance expert. Greg, welcome. How are you?
I'm doing great, Lance. I've been looking forward to this.
Yes, me too. Looking forward to asking you some more questions. But before we get started, I want to give some ground rules on how this is going to work. If you're joining your first Zoom webinar, you're all on mute. If you do have any questions, we want to answer those. So find the Q&A section on your Zoom screen. You can type your questions out there. I'm going to be monitoring those questions to ask Greg. And we have two more experts who are going to be in the Q&A section submitting typed responses to your answers or your questions. Those people are Mark Hamrick, who is Bankrate's Washington Bureau Chief and Senior Economic Analyst. He's an expert on the economy and a range of personal finance topics. And Ted Rossman, who is a credit cards industry analyst for Bankrate. Has a deep knowledge of the credit space and is also a great resource for personal finance information. Lastly, we're going to be emailing a recording of this webinar to you after it's over. So if you miss something, no problem. You're going to be able to go back and watch the entire thing. Additionally, we're going to send you a Greg's end of year financial checklist for 15 things you want to cross off financial tasks to complete before the end of the year. So keep an eye out for that. We're going to send it to everyone who signed up for this webinar. All right, so find that Q&A section. I'm going to be monitoring those for questions to ask Greg. Greg, you ready to go with some questions?
I am ready, yes.
Cool. So first up, wanted to get the latest on stimulus relief. I know that we have an election behind us, and we haven't seen any additional rounds of stimulus for a while. Any idea on the prospects of if there's going to be some type of stimulus, whatever form that takes, anytime soon?
I'm not a political handicapper, but it just looks, like we're not going to see anything in the immediate future. And who knows, it may have to wait not only until after the first of the year, maybe past Inauguration Day. I mean, keep in mind, some of these provisions expire July 31st. A lot of consumers, a lot of small businesses have been hurting for months on end, and they're getting closer to the edge the longer this drags out. The chairman of JP Morgan Chase, Jamie Dimon, yesterday, referred to the, Congress as being childish and, not, playing politics and not getting something done for consumers and small businesses in need. And, I think that's a pretty accurate assessment.
Yeah, agreed. And it's something to watch, especially as, cases are on the rise and it's just a troubling situation. So we'll be looking for any developments there. For homeowners, the first 6 months of forbearance under the CARES Act have ended. So lots of those forbearances are rolling off. For homeowners who are still facing financial hardship, what can they do?
Yeah, it's important to recognize that, that forbearance, a lot of those that are rolling off, if you are still experiencing financial difficulty, you can get an additional 6 months. The CARES Act provision called for 2 180-day periods of forbearance, but at the end of the first 180-day period, you had to, raise your hand and indicate if you were still in financial difficulty to get the next 6 months. So, my concern is that not all of those rolling off are rolling off because they're getting back to work and their incomes are bouncing back and they're able to resume making their payments, but that people that may be still experiencing financial difficulty, that forbearance has ended and they don't know that they can renew it for an additional 6 months. So I think that's an absolutely, critical point for a lot of people because that is the biggest component of the household budget. And if you can get payment relief on that for any length of time, it goes a long way towards, just keeping your head above water with regard to the other bills, and then also getting back on your financial feet once you do get back to work.
So the main takeaway there is if you are in need of it and unsure to ask.
Yeah, exactly. I mean, it's just because your first 6 months ended doesn't mean that you're done. If you're still experiencing financial difficulty under the CARES Act, if you have a government-backed mortgage, you can get that renewed for an additional 180 days. Even if you don't have a government-backed loan, if you're still in financial difficulty, talk to your lender. Payment options are available, but the key is you got to raise your hand and ask for it.
An important question or an important deadline to watch for, in addition to the homeowners, student loan forbearance is ending on December 31st. And this included suspending loan payments, stopping collections, and waiving interest on federal student loans, not necessarily private. For those who do have federal student loans, what should they be doing now to prepare for this period coming to an end?
Well, first off, if you're in the position where you're working and you can make payments, now is the time to put the hammer down because there's no interest accruing. So every dollar you throw at this is going to go towards knocking that balance down. So if you're fortunate enough to be in the position where you can continue making your payments or even double down on the payments, now is the time to do it. If instead you've really benefited from this forbearance and are concerned about it coming to an end, start working on your budget and see, if how you're going to fit those payments in should the required payments resume. Look at an income-based repayment plan. Particularly if you've taken a new job and you're making less than you were before, you may be eligible for an income-based repayment plan that would reduce those required monthly payments. One of the beauties of federal student loans is that it does have a lot of these very favorable provisions that do not extend to, as you noted, private student loans or a lot of other forms of credit. So utilize the ability to have forbearance, get deferment or income-based repayment options to provide relief for your budget.
Before we get to the refinancing your mortgage questions, we got a question in from a viewer, Byrne, who asks, and I might get some of this wrong, so Greg, forgive me if there's things I'm not kind of conveying correctly here. Is there availability anywhere for SFD residential owner occupied first lien Heloc loans? I can repeat that if I need to.
Yeah, I'd repeat that if you would, especially the first part.
Availability anywhere for SFD residential owner occupied first lien Heloc loans.
Well, I mean, I'm not familiar with the terminology of the SFD, but first lien home equity line of credit loans, yes, those are still available. One of the reasons that we've seen restrictions on and tighter credit on home equity lending is because it's often in the second lien position. Well, lenders are not jumping up and down to be in a second lien position at a time when the economy is in recession and there's a prospect of delinquencies, defaults, and foreclosures, right? But if it's going to be in the first lien position, that alleviates a lot of that risk. And so credit not nearly as tight in that position. If shop around, you can look at bankrate.com and seek out the best terms. Also keep in mind, a lot of lenders have introductory rates that might be good for the first 6 or 12 months before they jump to a higher rate. That's perfect if you only need this money for a temporary period of time, maybe until you sell, another piece of real estate and can pay it off, something of that nature. But yes, there are home equity lines of credit that are available. You just have to have equity. And if you're in a position where this can be their first lien, you've got all the equity they're looking for.
Byrne does clarify that it is a single family dwelling. So thanks for your answer there, Greg. A couple of questions that just came in. Perfect timing. We're about to talk about refinancing your mortgage. A question from Kim Wynn in FM. Where do you see mortgage rates going? And if you're financially able, is this a good time to refinance, or do you think rates will go even lower?
This is a great time to refinance. Mortgage rates are at record lows. Yesterday's Bankrate survey, the 30-year fixed rate tied a record low. The jumbo 30-year fixed also hit a record low of its own. So yes, this is a great time to do it. I think you have to be careful what you wish for. The outlook or the prospect for where rates head still lower is not one that's a favorable economic backdrop, right? So you don't want to be rooting against the home team in order to score better rates. I mean, the perverse thing is that bad news for the economy tends to be good news for mortgage rates. If the economy continues on a track towards recovery, and particularly as we get, say, in the middle of next year, the vaccines become widely available, that's going to put upward pressure on rates. The downward pressure would come from just if the economy, if the recovery completely stumbled, something like that. We've got a lot of virus cases surging right now, so the near future is going to be bumpy. But when it comes to refinancing, it's like having a stack of money on a table in front of you, right? And if rates move against you, that stack can get smaller or disappear completely. So I'm just a big fan of grab it while it's there, rather than obsessing about over every possible eighth of a percentage point when there's no guarantee that rates are going to move lower, and you have the risk as time goes on and the economy heals, that rates go higher.
And at least in Bankrate's weekly survey over the past few weeks, like they've been hitting, record lows, but it's like, even a basis point drop from a record low is another record low. The drops week to week have been fairly minimal. Is that correct?
That is right. Yeah, rates have been pretty range bound, for really the last several months, and so your risk is that it breaks out of that range. And the thing about refinancing is, when you're buying a house, whether rates are 3 or 3.25, it makes a little difference in the payment, but it's generally not a deal breaker. Well, when it comes to refinancing, those moves can have a significant impact on the calculus of whether or not you're going to do it. So right now, the median mortgage rate's about 3.75, according to our recent refinancing survey. You can lock in a 30-year fixed rate with 0 points at 2.75. You can shave a full percentage point off of that. I wouldn't gamble with that. I'd take advantage of the opportunity and jump on it while I can.
Yeah, the math checks out. That is a smart move. A viewer asked, what's the protocol with refinancing after you have ended forbearance and you have started payments and are back on schedule? Is it 3-month window, 6 months, a year? What does that look like?
Yeah, that's a good question. This is kind of uncharted territory in a way because of the fact that we've had these mass forbearance programs, right? This, not the traditional, case-by-case basis forbearance, or those that were confined to a particular area where there was a natural disaster, and there might be some question about, the collateral value of the home. With these mass programs, I suspect that there's going to be greater availability of refinancing, specifically rate and term refinancing, not taking extra cash out, but just refinancing the balance you currently have at a lower rate. If as you roll off of that forbearance and get back to making regular payments, after you've made a couple of payments, I'd get on the horn with your lender and start asking about it, right? I mean, and you want to be able to jump on the opportunity as soon as it exists. My sense is that that's probably going to come sooner rather than later, given the mass scale of these forbearances we've seen.
Getting some great questions from viewers. Another viewer asks, is the fee charged by Fannie and Freddie for refinances still in play starting on December 1st?
Yes, it is, unfortunately. And it's large. It's basically reflected in the pricing that you see right now. So it's not something that's going to pop up on your closing cost or show up on your loan statement as an additional fee. What we've seen is that lenders are typically marking up the rate about 1/8 of a percentage point to reflect that. And that's reflected in the rates you see today. So when you're shopping around and you see that, wow, 2.75, it's not, well, 2.75, but then, I got to think about that fee. Now, 2.75 includes that fee. So, it's definitely not a consumer-friendly development by any means, but, limited damage, and it comes at a time when rates are still at record lows. So it's not something that should be a hindrance to refinancing if you're in that zone to do so.
Cheryl asks, she says she wants to refinance her parents' home. It's in a trust and she has the power of attorney as well as being a trustee on the trust. Can she refinance the home? She says her parents are unable.
You're probably gonna have to talk to a real estate attorney about that because of the trust owning the home. Lenders are going to need documentation, income verification of ownership, and that's where it might get a little bit cloudy. So I would talk first with a real estate attorney, and then they at that point may direct you towards talking to a lender. But that's not going to be your typical run-of-the-mill refinancing, just because of that structure.
Lots of refinancing questions. We're just going to ride the wave here. Another viewer asks how to find a reputable mortgage broker for refinancing.
Well, I'll do a little cheerleading for the home team here. Check out Bankrate.com. We do the comparison shopping for you. So we put a lot of the very best offers that are available in your area. You can find them on our website. Some are mortgage brokers, others are mortgage banks, and others are banks or credit unions. I'm a fan of casting a wide net. I would not limit yourself to just one entity, but look, see who's offering the best terms. You want to put in multiple applications, and so this is another opportunity to kind of maybe spread the eggs in different baskets, at least at the outset, to see who's really going to come through and give you the best deal in terms of rate and fees. But by all means, include mortgage brokers in that search. Everybody that's listed on Bankrate.com, whether they're a mortgage broker, mortgage bank, credit union, they're all vetted. They're all properly licensed and regulated to do business in that state that they're listed on Bankrate.com. That's an assurance that we provide to our site visitors.
Hania asks, should you refinance if you want to sell in the next few months?
No, no, because you're not going to get the benefit of refinancing. Refinancing is not free. There is a cost involved in doing so. And it typically takes a year or two, sometimes even more, to break even, to earn back those costs through the monthly savings. If you're planning on selling in the near term, no, you're not going to earn that back. So yes, rates might be low, but it's not something that's going to benefit you if you don't plan on being in the home much longer.
Another viewer question, how is your credit affected by doing multiple or shopping for multiple rates?
This is a great question, and I've got good news. You're not punished for shopping around. Now, the credit scoring models take this into account. And so what they do is, they will aggregate all of your mortgage credit inquiries that occur within a particular period of time. And then there's also a look back where it basically ignores any of the mortgage inquiries you've had in the past 30 days. So, this is good news. You're not punished for shopping around, but you also want to do it in a concise period of time. You put a mortgage application in now and then don't do anything. And then 2 months, come back and do another one and then don't do anything. That's a different story. But, if you're doing, as we advise, shopping around, applying with up to 3 different lenders at the same time to get an apples to apples comparison, you're not penalized for doing that. It's pure upside.
Dennis asks for an explanation of the correlation between the 10-year treasury yield and 30-year mortgage rates. Can you explain how if one goes up, the other goes down and vice versa? Sure.
The 10-year treasury, and that's issued by the U.S. government, and that's what's known as the risk-free rate. In other words, there's no risk of default because the government can always print more money to pay the bill, right? So that's the baseline for determining the rates and yields for various different types of bonds. And the other types of bonds are going to have higher yields that are reflective of the risk that they have. Again, keeping in mind that the baseline, the treasury, is free of default risk. So those that have a higher risk of default are going to have higher rates. Those with lower risk of default will have lower rates. Mortgages are typically packaged together and sold as bonds. That's that correlation between the rate you get quoted on a mortgage and the 10-year treasury, because it's priced, as when it's put together into a mortgage-backed bond. Now that spread is not constant; it can fluctuate. Directionally, they move together, but it's not always one for one. That spread can expand; it can narrow. We've seen both this year, but generally speaking, when an environment where you've got an outlook for faster economic growth and higher inflation, that's going to push treasury yields up. It's going to take mortgage rates up too. Maybe not by the same amount, but directionally. And the same in reverse is true. That's why we've got record low mortgage rates this year. The economy rolled over earlier in the year. Where did investors want it to be? The safe haven of U.S. treasuries. Treasury yields plummeted, and so too did the mortgage rates that are priced relative to that.
Attila asks for your opinion on the real estate market in the next 12 to 18 months.
Well, right now the real estate market is white hot in most parts of the country. Home sales are at a 14-year high. Mortgage rates are at record lows, so people have affordability. There's a real limited inventory of homes available for sale. People are moving out of urban centers more towards suburbs, or moving from one state to another, now given the freedom to work from home. So there's a lot going on in the real estate market. As we get into 2021, though, we're going to start to see these forbearances start to roll off. And so 2021 is going to bring the delinquencies, the defaults, and ultimately the early stages of foreclosures that we didn't see in 2020. So I think that's going to take a little bit of momentum away from housing. It's not going to happen right away. It may be middle to back half of next year before you really start to see this. The CARES Act, for example, those forbearances really don't start rolling off till about April. So it'll take some time, for those to become 30 days, 60 days, 90 days delinquent, pursue foreclosure, that kind of thing. But the more that happens, the more momentum it's going to take away from housing. People talk about a housing bubble. I don't see it. I mean, yes, there might be isolated markets where, prices are just completely divorced from reality. And yes, there's always, subject to, price correction there. But generally speaking, and certainly on a national basis, I find the notion of a housing bubble just to be completely off base.
Yeah, housing has been really interesting to watch during the pandemic. Is you mentioned it's been white hot as other industries have kind of just had a challenge. Another viewer asks if it's worth it to refinance if the mortgage is going to be paid off in a short period of time, like 4 years.
Yeah, in that case, you're not going to get much benefit. I mean, think if, it takes you 2 years to earn back your costs of refinancing, that gives you pretty limited benefit. And, that's assuming that you've got a good sized balance, right? If you've been paying down that balance and you're close to paying it off within 4 years, you've got a pretty small balance. Well, refinancing to a lower rate is going to have minimal benefit from doing so. So, time horizon with the mortgage or in the home is absolutely critical to determining whether or not refinancing works. If you're planning on moving in the next 3-4 years, no, it doesn't work. But the same is true if you plan on paying off your loan for either because the balance is coming down or you expect a windfall that's going to enable you to pay it off. In that case, refinancing not going to prove fruitful.
Another question. This person says they're already in a 15-year mortgage, so I'm assuming they're talking about refinancing here. Are there any 8-year mortgage loans available, or is the 10-year this person's only option?
The 10-year is not your only option. It's more widely available. There are these, customized terms that are available that you can find. However, keep in mind, that's not necessarily going to get you a better rate than going with something like a 10-year. Products that are, a little more standardized, that's, tends to be where the better rates are. And then also with the 10-year, you still have the flexibility to pay it off in 8 years if you desire. So, if I wouldn't fixate on the idea of, I want to get this thing paid off in 8 years. I want to get an 8-year mortgage. You can get a 10-year. The rate is probably going to be same, and certainly, probably not any worse than what you would get if you did, keep digging to find that 8-year mortgage, but you still have the flexibility to pay it off in 8 years. I like that idea better. So don't put the blinders on and limit yourself. The 10-year may end up being a prudent way to go.
I've got one more mortgage question, and then we'll move on to budgeting and credit card strategies. And then if there are any refi or mortgage questions later on, we can definitely circle back to it. Greg, I know this is a topic that's you're passionate about. Kim Wynn asks, what are your thoughts on reverse mortgages?
Well, I think reverse mortgages as a tool are very useful and are going to be a lifeline for millions of retirees that, either those that are already retired or those that are nearing retirement, that they may have $400,000 of equity in their home because they've lived there for 30 years, but they don't have $400,000 in their 401k. And so the reverse mortgage becomes the tool through which they can extract that equity and provide themselves either a line of credit or a regular stream of income in retirement. So as a tool, I'm a big fan of reverse mortgages. There are a ton of misconceptions out there, some that are just flat out false. And, I guess, I could go on all afternoon about those, but I suffice it to say, just like any other mortgage product, shop around, compare terms, talk to multiple lenders, deal with, a reputable entity that is appropriately licensed, do a little bit of due diligence, make sure that they haven't been the subject of, any complaints for, elder, if elder financial abuse, those kind of things. But, if you do that kind of homework, it's just like getting a regular forward mortgage. This can be a very advantageous tool, particularly for those that are long on equity, but short on other assets entering the golden years.
So let's talk holiday spending. Holidays can be a financial stress in a normal year, and especially this year for many who have taken a financial hit because of the COVID pandemic. Greg, what are your tips for keeping spending in check? This holiday season. Maybe for general advice for any holiday season, and then if you're kind of facing a financial challenges this year.
Yeah, a couple of things. I mean, first is, and I don't mean to be glib when I say this, but the holidays do come at the same time every year, right? So it's not something that should necessarily sneak up on you. Yet, time and again, we see that sort of lack of planning, or maybe just going a little bit overboard, can wreck the financial progress that you've made through much of the preceding 10, 11 months of the year, right? And then so you end up going into the new year digging yourself out of a hole instead of building on the momentum you'd established the previous year, or charting a new financial course. And so I would keep that in mind. Listen, if there's ever a year where you're going to get a pass on scaling back the gift giving, this is the year to do it. Millions of people have been out of work, millions more are working but making a lot less. Holiday gatherings themselves, a lot of families are just going to skip it altogether, or it's going to be a lot smaller gathering than it had been. So look, I think you've got to prioritize your own financial situation and well-being above saving face of getting that gift just because you have to for that annoying brother-in-law. And I've been that annoying brother-in-law, by the way. So look, plan ahead, see what your budget can take, and again, operate with the mindset of, if your budget can't take it, there's no better year than this year to scale back, take a pass on it. You'll be better for it if you're moving into the new year, charting a new financial course or building on positive momentum, rather than trying to dig yourself out of a hole of debt that you may have accumulated, or burning through a bunch of savings that you were low on to begin with, just to satisfy the annoying brother-in-law, among others.
Yeah, I love that. Definitely have a plan, and plan ahead for that. I'm going to bring in Ted Rossman really quickly for a credit card question. Ted, you there?
I am. Hey, Lance.
All right. Hey, Ted, thanks for joining us. As I mentioned earlier, Ted is Bankrate's credit card analyst, so knows all the ins and outs of the credit card world. I have a question for you on holiday spending and credit cards. Cards can play a big part of your holiday spending strategy, whether you're using points to pay for gifts or travel, probably less travel this year, or using certain cards to earn points or cash back. So Ted, what are your top tips for using credit cards during the holidays?
Well, the first question you need to ask yourself is whether or not you're going to be carrying a balance, because Greg's been talking about record low mortgage rates. We're certainly not seeing record low credit card rates. These are much higher. The national average is about 16%. Many people are paying 20, 25, sometimes even 30%. So you want your credit cards to work for you, not against you. So first of all, if you have credit card debt, let's try to pay it down, not add to it. Maybe you do need to stick to cash or debit. There's some other strategies you can play to get out of debt: balance transfers, personal loans, nonprofit credit counseling, things like that. Now, if you're in this good camp where your credit cards can work for you, as in you're paying your bills in full, you're able to take advantage of rewards, well, then there's a lot of great opportunities, because then you can get cash back, you can get travel miles, you can take advantage of buyer protections like extended warranties, purchase protection that'll reimburse you if something breaks. That's where you can really be thoughtful about using the right cards, maximizing them, maybe even signing up for a new card if you can turn that holiday spending into a sign-up bonus. But that's the big starting point: is, do you have credit card debt or not? I would start there.
Yeah, those credit card rates are absolutely brutal. We always stress, if you're going to play the credit card game, you have to pay that bill off every month, or else you're definitely not helping yourself. Ted, I'm curious, we saw at the beginning of the pandemic and kind of in the middle of the year, issuers kind of backed away from those balance transfer, 0% balance transfer offers. Is that correct?
Yes, it is. In fact, there's a study from Mintel that says that about 42% fewer balance transfer offers were mailed out this year to consumers. It really is more of a risk-off environment. Balance transfers, of course, are when you take debt from one card and move it over to another. There's just not that appetite for risk right now. Lenders are worried about taking on other people's debt. Maybe if you have a really good credit score and a steady income, it's still available. I think better options nowadays are nonprofit credit counseling. Agencies like Money Management International and GreenPath can give you great advice. They can negotiate lower rates on your behalf. They can consolidate your payments. That's a good option, especially if you owe several $1,000s or more. A way to try to do it yourself would be to opt into programs like Amex Pay at Planet or Citi Flex Pay or My Chase Plan. These are programs available from your existing card issuer, and you can designate certain purchases that you pay off in installments. So by promising to pay them off, let's say in a year, you might get a 7 or 10% interest rate instead of 15 or 20%.
Ted, we got a few credit card questions in. You want to hang on for a second?
Yeah, let's do it.
All right. First one, is there a strategy for asking credit card lenders for a lower rate?
There is. Now, first of all, nothing ventured, nothing gained, right? There's really no risk to asking this question. I would point out that you're unlikely to get them from 15% down to 0. I mean, chances are maybe you trim a few points off of that. If you come armed with competitive offers, that can help. So either like, hey, I saw this advertised on Bankrate, or I got this in the mail, or can you match this other deal? That can be a good strategy. We did a study a couple of years ago, and we found that more than half the time when people ask for a lower interest rate, they get it. So it's definitely worth a try, but consider some of those other options too, because just moving from 15% to 12, it's something, but it's not a huge savings. I think the bigger part is how can we pay it down and make your personal rate 0, as in being debt-free?
Absolutely. Another question from Dennis. Regarding credit cards, do you think the cost of all those rewards programs are ultimately being passed back to the consumer? For example, higher fees charged to the company, and then the company then increases their prices to the consumer.
This is a common critique that some people put out there, which is basically that the people carrying balances are the ones who are subsidizing rewards for the rest of us. I suppose maybe it's true to some extent, but I think ultimately what's most important for you is being in that roughly half of Americans who are debt-free and getting those credit cards working for you. We're not really here to reinvent the system or fight the system. I think really what you need to do is pay those balances down. I would point out that, and this is an argument retailers make a lot, they don't like interchange fees. They don't like paying 2 or 3% of every purchase when you use a credit card to that card company. These rewards end up being kind of a revenue share there, but let's face it, debit card interchange has been capped for about 10 years now. We haven't really seen prices come down. So I think ultimately that's a fight between retailers and card companies. The way we can benefit is paying our credit card bills in full and getting those rewards.
Kay Miller has a great question. Is a personal loan better than moving a credit card balance to a 0 interest credit card?
Personal loans, like balance transfers, have gotten harder to get this year. It's the same kind of risk off model. If you have a good credit score, I'm going to say probably mid 700s or better, you have a good chance of getting approved. But a year ago, I would have said upper 600s, you're probably fine. So the bar has definitely been raised. There have been some changes in the credit scoring system that are now treating personal loans as their own category. Basically, what they're ultimately talking about here is credit utilization. So like how much credit you're using divided by credit available to you. Some people were kind of, gaming the system a little bit and taking out personal loans and then still continuing to rack up credit card debt. So really what we want to do ultimately is be moving in the right direction. So don't just move your debt around. I mean, at the end of the day, we really want you to pay it off. So, get the best interest rate you can. If you can qualify for a low rate personal loan and be dedicated about paying it down, I think that's a great option. If you can qualify for a low rate balance transfer and pay it down, that's a great option too. Realizing these have gotten harder, I think ultimately at the end of this, really what we want is to pay down that debt, not so much to worry about the semantics of how you're doing it.
So last comment, question for readers on the credit cards here, and we can move on to open Q&A. Kate makes the comment, remind people that if they do a balance transfer, they are paying the first year of interest upfront by having it added to their balance. Ted, do you want to extrapolate on that and just kind of explain how balance transfers work?
So a few things to be aware of on balance transfers. I mentioned that unfortunately they've gotten harder to get this year because of risk aversion. Hopefully they bounce back next year and beyond as the economy hopefully does. They are still out there for some people. The terms are not as good. And we've seen the the 0% periods shrink. We've seen the upfront fees go up. That's another thing where most of the time they're going to hit you with a 3 or 5% fee upfront. It could be well worth it, but that's something that you want to factor in to your calculation. Really, what you want to think about is sort of the total cost of ownership there. That what's the upfront fee? How long of a 0% period am I getting? Can I really make the commitment to hopefully pay it off within that time? Because like I said before, what you don't want to do is just be in the habit of hopping from one to the other. You really want to make progress, not just kick the can down the road. So if you make those behavioral modifications and you get the tailwind of a lower rate, that's a good way to go.
Completely agree. Ted, thanks for jumping in and answering a few credit card questions. For the viewers who do have credit card questions, feel free to ask them. Ted's going to be in the Q&A typing some responses, so definitely ask those. So thanks again, Ted.
My pleasure. Thanks.
Thanks, Ted.
All right, Greg, you back on?
I'm here.
Ready for open Q&A? This is the most fun part of the whole thing.
It is. Let's do it.
All right. Question from Eliza. Are there any advantages to refinancing with your existing mortgage lender versus choosing a new lender in terms of reduced costs or any other benefits?
There can be, but it's not a hard and fast rule. And this is why you want to shop around. But part of that shopping around is include your current lender in the process, simply because they have some of your information, depending on how recently the loan was issued. They might be able to streamline that process and save you not only time, but money. But don't stop there. You do want to compare terms. Not everybody charges the same price. And we do see, a significant variation in rates that are being offered, even to, a borrower with the same qualifications. So that's the advantage of shopping around. But by all means, include your current lender in that process. Just don't limit it to them.
Nancy asks, if a refinance offer is received and you proceed to fill out the application, will the interest rate be different if interest rates go up or down? So basically explaining how do you lock in that rate?
Yeah, so the way this works is, you put in an application and then that application gets processed. And as you get closer to closing, you're going to be given the option to lock that interest rate. Because until that happens, you are subject to the whims of the market if it were to move against you. Once you lock that rate in, that lock is good for a certain period of days. So you better be sure that you're going to close within that window of time, because when that rate lock expires, if you want to extend it, it is very costly to do so. And so, it's a little bit of a dance, and you can, work with your lender on this just to, kind of keep tabs on, where you are in the process, how much more time till closing, in a consultative way, like, what are the different options in terms of locking, and, where's the optimal window to do that, because you don't want to lock too early, but at the same token, you don't want to lock too late either, right? And then rates move up and, you're kicking yourself because, rates jump to, an eighth of a point or quarter of a point in, since yesterday, and dang it, I didn't lock in when I had the chance.
Another question. My ex and I broke up a couple years ago, and I've stayed in the house paying the mortgage. Is refinancing the only option to get him off the mortgage?
Well, yeah, because you're regardless of what you're, if you were married and you're now divorced, regardless of what the divorce decree says, the lender has a contract with both of you, i.e. that loan. So if you're both on the loan, then yes, you likely having to look at refinancing in order to get the other person off the loan. Now, the good news is rates are record lows. So even if you were together, you might still be refinancing anyway. So, the timing may work out in a beneficial way for you.
Eric asks, is there any validity to the FHA Streamline program? And if so, what is the best way to implement this in regards to refinancing a home?
Yeah, FHA Streamline is, again, if you already have an FHA loan and you want to refinance, it does, kind of speed that process along. Thing about FHA loans, they have fees that carry for the life of the loan. And so you've got to look beyond just the rate when you're looking at that refinancing. The reality of it is, oftentimes if you've built up enough equity, you may want to refinance into a traditional like a Fannie Mae or a Freddie Mac loan that doesn't carry that lifelong fee, and you can truly capitalize on the benefit of lower rates, without the add-on of what is effectively mortgage insurance for the term of the loan.
Got a couple of Heloc questions for you, Greg. First one from Leonard. Is it possible to refinance my first loan but keep my Heloc?
Yes, but what's going to happen is that Heloc lender is going to have to do what's called resubordinate. In other words, when the first mortgage gets paid off, that second lien holder, they've got to sign off on the fact that, yeah, I'm not going to move up to the number one spot. There's going to be another lender that comes in at the top spot. That's a pretty standard thing. It's, the only time that lenders really fight that is if, like, for example, the loan is behind. We saw a lot of that in the housing bust, for example, that, when it came to, short sales or things like that, the Heloc lenders were refusing to resubordinate liens and things like that. But that's a pretty standard procedure. Account for the fact that that might add a little bit of time to that refinancing timetable. So when we were talking a moment ago about, when to pull the string and lock that rate, that's one of those details you may want to factor in is, okay, that resubordination, if there's a delay, if it takes more than a day or two on that, is that going to screw up my timetable?
Question from Pamela. Are Helocs still an option for emergency cash? I know that Helocs are one of those things that were hard to find during the height of the pandemic. Are those still an option?
Well, Helocs are an option. Emergency cash, maybe not so much. And here's why. Because that's a second lien position, those are lenders that are very risk averse. That's why we saw Helocs tighten up, the availability of credit tighten up so much in the early days of the pandemic. And you saw lenders either really raising their credit score requirements or just stopping doing home equity lines at all, or not only doing them for existing customers because they're looking to mitigate that risk. So if you've got a lot of equity in your home and you're still working and your debt ratio is in line, you got a good credit score, yes, Helocs are widely available and lenders are eager to do business with you. If you're out of work, you're falling behind on your bills, but you got a lot of equity in your home and you're looking at a home equity line as your lifeline, then no, it's not going to be an option because that it still has to go through the same underwriting as any other loan. Lenders are going to look at your income, they're going to verify your employment, they're going to make sure your credit and debt ratios are in line. So, if that's not the case, it won't be an option.
Sashi asks, can you improve your credit score by making extra payments toward your mortgage principal? And if so, when should they be done? That is, mid-month or end of the year.
There are about 150 other things that you could do with that money that would be better than paying down a mortgage with the idea that it's going to improve your credit score. So, Ted was talking earlier about credit utilization. Where that comes into play very heavily in your terms of your credit score is on revolving debt. If you're just making your regular mortgage payments and that loan is amortizing, that balance is coming down. Put your extra dollars towards paying off that not only higher rate debt, but even if you pay your credit card balances in full every month, maybe you make multiple payments every month to keep that credit utilization rate low. That's what's going to help your credit score. If you can keep that credit utilization below 10%, that's where it's an actual plus for your credit score. So I would focus those extra dollars in that direction. Paying down a low fixed rate mortgage is really a comparatively low financial priority, and especially in the context of steps taken to improve credit score.
Hanaya asks, if I have a traditional IRA, can you transfer to a Roth or your 401k without penalty?
Well, the language that you're looking for is to convert to a Roth IRA, and that is a taxable event. Now, rolling that into a 401k, that's going to depend on that 401k plan if they do accept incoming rollovers, either from previous employer 401ks or traditional IRAs. But you're talking about two different roads, right? There's a fork in the road, and you're talking about one of two different directions. Converting that to a Roth IRA is going to be a taxable event. And so in other words, all that pre-tax money that hadn't been taxed before is now going to be taxable. But the benefit is, as you go further down that road, we'll call it Roth road, all of your future gains are tax-free. If you're talking about rolling it over into a 401k, and that would be a direct rollover, it keeps it in that protective pre-tax bubble. And so it doesn't trigger a taxable event. And importantly, doing that direct rollover is critical. Don't cash it out and, with the idea that you're going to send the money. And no, you want to have it go directly from trustee to trustee.
I really like a Roth Road. Another question. I have a nice 401k portfolio, but I have to take a required distribution every year. I have about 75,000 just sitting in a Chase checking account with about zero interest. I don't need the cash, but I'm not sure what or where to invest it for a nice return, but to make it somewhat available. Any suggestions for that checking account cash?
Well, it really is kind of going to depend on your time horizon and what possible uses you might have for it. So let me just kind of give a couple quick examples that kind of run the gamut. If this is money that you want available, at a moment's notice for whatever the case may be, then put it into something like an online savings account. It's certainly going to give you a better rate of interest than you're not getting in your checking account. If, on the other hand, this is money that, like, geez, I don't know if I'll ever need this money. Well, maybe you want to do something like fund a 529 for, grandchildren or children that are, pursuing higher education. Maybe you want to invest this money more aggressively with the idea that it's going to be used by future generations, not by you yourself. And in that case, you would take a more aggressive investment stance, putting it in the stock market, for example. So those are kind of bookends of the spectrum. But ultimately, where you settle on that, I think, depends more on the time horizon and potential need for that money than anything else.
Another question: can I apply for a reverse mortgage after being turned down by a single company? And if yes, how?
Look, just because you got turned down one place, doesn't mean you can't get approved someplace else. The odds might be against you. I mean, I think a lot of it depends on what was the reasoning that the initial lender declined you. That's very likely to hold, at other lenders as well. So I think that's an important detail to dig into. So my answer to that would be not necessarily. It's not necessarily a preventative from being able to get approved by another lender, but depending upon the reason, it might not be something that, you can compensate for in another factor.
I've had this question bookmarked for a while now. A viewer asks for your assessment, how you feel bonds will perform in 2021, especially Treasury and agency. I'm not a fan of bonds in the sense that there's, two things at play. One, bond yields are so low, you're not getting a whole lot of income on them. And at the same token, it's exposing you to a greater level of interest rate risk that we've ever seen before, particularly on longer term bonds. And the way that interest rate risk works is bond prices and yields move inversely to one another. This year, interest rates have gone down, and so bond prices have gone up. A lot of those bond holdings, a lot of those bond funds are at premiums right now. Now, bonds are trading at above their face value. A bond might be trading at $120 when the par value at redemption is $100, right? We know it's going to go from 120 back to 100 at some point. Now is probably time to take a little money off the table, maybe sell some of those bonds, lighten up in areas where it's done really well, it's at a premium, and reduce your interest rate risk. Another option, move from longer term bonds into shorter term bonds, again, to limit the interest rate risk. With rates so low, it's not that rates can't fall further. Yeah, sure, if rates fall further, bond prices will go up again. But let's just look where we are. I mean, the 10-year Treasury right now is at 0.8%. They're not going to fall much further, right? I mean, but there's a whole lot of potential that it could jump higher. And listen, it could go from 0.8 to 1.8. That's still going to be an 8% loss, right? You're not signing up in bonds for an 8% loss. So I don't see a whole lot of appeal in bonds, aside from very short-term or inflation-indexed bonds. I would, in particular, avoid longer-term bonds, because of the interest rate risk. And, there's not a whole lot of income in the first place. Heidi has a question. She said they had to replace an air conditioning system. They have cash in their emergency fund, but chose to do a balance transfer from the credit card they used for it to a 0% 18-month card. Should they use their emergency savings to pay off that percent balance? I'm guessing it's coming due.
Well, and look, if you've got an 18-month window on which to use somebody else's money for free, go ahead and do it. Just be very disciplined about it. Know the date that expires. Like your birth date or anniversary, or actually better than anniversary. A lot of people forget the anniversary. Know it like your birthday, because it's that critical of a detail. So yeah, in that case, by all means, use other people's money, and then you get down to month 17, then yeah, you take the money out of your emergency savings and pay it off. Or, you chip away at it, right? You take the amount you owe, you divide it by 17 with the idea that I'm going to get this paid off just a month before it ends. And, you make regular payments to chip away at it, and you can leave your emergency fund intact. Yes. And importantly, don't use that credit card for other purchases in the meantime. So yes, that's fine. The exception to that would be those that don't have the best restraint when it comes to spending and credit cards, because, that's where the temptation is going to be to use that card for something else, or put off paying down that balance, and then the 18 months expires, and now you're carrying that same air conditioner balance at 16% instead of 0%. So some of this is going to require sort of looking yourself in the mirror and sort of knowing where you fit. But by and large, I like the idea of using somebody else's money as long as you can. The idea in keeping your emergency savings intact as long as you can.
We got about 10 minutes left. Still plenty of questions to get through, but if you have questions that you'd like to submit, please go ahead and do that. So maybe we can go through these, answer these quickly to get through as many as possible. Can you lock the mortgage rate with 2 or 3 lenders? And is there a penalty or fee you have to pay for not proceeding with the others, as you only complete the loan process with one?
Well, some of this is going to be, did you pay for, like an appraisal, for example? You're not going to do that with 3 different lenders, right? So, it's at some point you're going to abandon the process and stick with one lender. Usually that's the point at which people lock the rate. And at that point, usually you've invested some money in the process. So, I think, plus, you don't want to, be wasting your time or somebody else's on a loan you don't intend taking. It's usually that lock point where you've picked your dance partner.
Kay asks, or says she just refinanced to a conventional loan 2 weeks ago. How long does she have to wait until she refinances again?
Well, first thing is you need rates to drop a whole lot more, right? There's not a whole lot of advantage to doing it again soon if rates haven't dropped. So I think that's the big ingredient. But generally a little bit of seasoning in there. A year later, generally you'll be in a position. A lot of people do serial refinancing. I talked to somebody the other day that's already refinanced twice this year. So you can do so again after a period of months. But the key ingredient there is, again, rates dropping significantly enough to make it worthwhile.
I'm typing a response to V, who asked if there will be a recording of this. So for a reminder to anyone, or to answer a question for anyone who may have missed it earlier, we will be sending a recording of this. So anything you missed, you're going to be able to watch the entire thing. So that'll go in addition to Greg's end of year financial checklist. So everyone will be getting that. Josephine says, I'm nearly done paying off credit card debt and a few years away from paying off student loans. How do I build my credit in addition to paying my monthly student loan payment?
Well, paying down that credit card debt is going a long way towards building the credit too. This goes back to the discussion earlier that Ted was making about the credit utilization ratio. As you're paying down those credit card balances, you're freeing up more and more available credit. That reflects positively on your credit score. That and paying bills on time together those 2 components can account for almost 2/3 of your credit score. So, just keep doing what you're doing.
Marissa says, I will be a first-time home buyer, hopefully within the next year. Congratulations when you do that. Are there drawbacks to first-time home buyer incentive programs?
Drawbacks, I don't know, that maybe a little bit, heavy of a word. Listen, for a lot of people, buying that first home is really kind of getting them on, an upward escalator of stability and wealth creation, right? And so that's why these first-time home buyer incentive programs exist, is to get people to buy homes that, otherwise might be a little short on savings, or might, be lower or moderate income households in a higher cost area, those kind of things. I would not shy away from that if that's what gets you into that first home. That being said, if you're in a position where, you're able to qualify on your own and maybe you can buy a higher value property, then there's no sense to hem yourself in and limit yourself to something that has a first time home buyer incentive, because those tend to be for first time home buyer, starter homes, as opposed to maybe a larger move up property that you'd be looking at.
D asks if 203K renovation mortgages are still options during these low rate times.
Yes, they are. Not widely available, but yes, they are still. I don't know that there's necessarily been a lot of change in the credit tightness of those, but yes, those are loans that are still available.
B. Logan asks if you can discuss the benefits of IRRRL loans. I always struggle to get through that one. Those loans relative to commercial loans.
Not familiar with those. And commercial loans, that's outside the purview of Bankrate. We're a personal finance site.
All right. Kendra asks, I've read that the stimulus and costs of the pandemic are going to cause Social Security to reduce benefits even sooner than the 15 years from now that was projected to happen, lowering benefits by 25%. What do you think about that? Will the costs associated to the pandemic bring the reduced payments sooner, or at more than that 25% of the benefit amount?
Well, look, there's every day of the week, there's a different, sort of projection and doomsday forecast about Social Security. Point is, nobody really knows for sure. Just looking at the math, at some point, it's very likely they're going to have to reduce benefits, but it's going to be for people that are not yet retired, not people that are already retired. So, I think the perfect antidote to that is save more on your own. Give yourself more financial flexibility so that you are not dependent or overly dependent on Social Security. It was never intended to be the sole source of income in retirement. You just want it to be one leg on the stool of retirement savings. So, do your part. Save. If you've got a pension from another job, you're setting up some other. You've got other lines in the water in terms of income sources in retirement beyond just Social Security.
Dennis says he's always used a local mortgage broker with a brick and mortar shop that they trust with their personal information. Should he be concerned with personal information being secure if you're getting a competitive quote from some of these online lenders?
Listen, a lot of these online lenders, they're in many cases brick and mortar banks in their own right. They're just through the internet reaching a broader audience that way. I mentioned earlier on Bankrate.com, everybody that's listed, they are properly licensed and accredited in that particular state. So you're not dealing with somebody out of their garage. These are reputable entities here. And so you can, have a level of comfort with that.
Okay, just a few left here. Maggie asks or says she wants to purchase a home that's a little diamond in the rough. Are using or getting the FHA 203K loans hard to get?
They're not as widely available. You have to do a little bit more legwork, but particularly for properties that, like you said, a diamond in the rough, something that can be rehabbed and command a much higher value down the road. That's what those loans were created for. And so in that case, yes, those loans are still available. It's just not something that every lender on the street is offering.
All right, time for one last question. We got to get this one in quick. Miro asks, I did a private loan to a person to purchase a primary residence. Am I allowed to do another loan to another homeowner, or is this forbidden under Dodd-Frank? She lives in California. The homeowner was in Alabama.
Maybe if you're a private lender, no, there wouldn't be any particular limitation on that. You're basically setting up income streams. You can't do multiple, loans on the same property. Can't sell it to multiple people, but I'm going to presume that that's not what you're asking. Yes, just like any other lender, you'd be able to make loans to multiple people as long as they're secured by different residences.
All right, and we'll wrap up with that one. Thank you, everyone, for joining. This was a lot of fun, and thanks, Greg and Ted and Mark for all the expert insights. Definitely check us out on Bankrate.com. If you haven't signed up for an account today, you can get personalized resources for every step of your financial journey. Visit the site. We got all kinds of editorial content to help you, learn more about your money, and be on the lookout for upcoming webinars. Have a good holiday season.